The global financial landscape is witnessing a historic confrontation as Shanghai moves to challenge the long-standing dominance of Western markets over precious metals. Following the release of a comprehensive 18-point policy document by Shanghai authorities, China has signaled its intent to elevate its influence over the pricing and distribution of non-ferrous metals and major commodities. This maneuver is viewed by many as a direct challenge to the financial hegemony of the United States, marking a transition from China being the world's factory to becoming a primary rulemaker in global finance. The surge in gold and silver prices has defied traditional market expectations and resisted downward pressure from bearish forecasts. While gold has reached significant milestones near 4,800 points, silver is rapidly approaching a valuation of 100. This rally is underpinned by an aggressive shift in market dynamics where physical demand is overriding speculative paper trading. Observers note that even as some institutions attempted to sell off contracts to rebalance portfolios, active buying power quickly absorbed the supply, pushing prices to new heights and confirming a long-term bullish trend. Silver has emerged as a central pillar in this strategic struggle due to its dual role as a monetary asset and a critical industrial component. As the most conductive metal on Earth, it is indispensable for high-tech sectors including artificial intelligence, renewable energy, commercial aerospace, and robotics. China, as a leading producer and the largest consumer of silver, is facing a massive internal supply gap driven by its rapid energy transition and the expansion of computing power centers. Projections suggest that domestic demand could reach nearly 10,000 tons annually, far exceeding local production and necessitating significant imports. The core of this conflict lies in the divergence between the New York and Shanghai pricing models. For decades, the New York Mercantile Exchange dictated global prices through paper-based silver contracts. However, as Western economies face industrial hollowing and a lack of physical inventory, the market is shifting toward Shanghai, where prices are backed by actual physical reserves and industrial utility. By leveraging its control over the supply chain and implementing export restrictions similar to those placed on rare earth elements, China is positioning the renminbi-denominated Shanghai price as the new global benchmark. This transition represents more than a simple fluctuation in commodity costs. It is a fundamental restructuring of how global resources are allocated and how the future monetary system will be defined.